Hello, welcome to 9 minutes and 59 seconds to financial freedom. Why not 10 minutes? Well, 10 minutes was already taken, and their video is not as cool as this. Anyway, what you're going to learn in this series is how to protect your portfolio from the type of wipeout experienced in the 2008 financial crisis. You'll learn when to get into a stock, when to get out of it, or the market in general, for profit and for portfolio protection. In the 2008 crisis, my 401k suffered less than a 7% hit. In this guide, I'll share with you the tools that I used to protect my portfolio so that you can do the same to yours. In a few moments, I'm going to show you how, with less than 10 minutes invested from any computer anywhere in the world, how you can tell if your stock, portfolios, mutual funds, ETFs, or any other financial instruments on which you can chart are about to take a hit. This information means that you'll never make an uninformed choice when it comes to investing in any publicly traded entity that has a price chart. You'll be in charge. You'll take control. If only your stockbroker lived by the motto, first, do no harm, you and your portfolio would be in much better shape today, and there'd be no need for a video series such as this. That isn't the world we live in, though. Allow me to show you how to take control of your financial destiny with just a short investment of your time. Let's get right to it. I use yahoofinance.com for all of my examples because of the simplicity of the layout of the page, easy of finding everything else on the page. For this example and these that follow, we'll use the Dow Jones Industrial Average. Now when you first click on the Yahoo Finance page and you click on the Dow, it brings up a page that looks very much like this. On the left hand side of the page are the items we'll be clicking on. Specifically, under charts where it says interactive, you'll click on that. It'll quickly bring up a price chart of the Dow Jones Industrial Average over a 1-day period, as highlighted on the bottom of the page. I've found that the most useful information is gathered from looking at the time periods of 3, 6, and 1 year. So for this example, we're going to use the 6-month period. So here's a chart of the Dow Jones Industrial Average over the last 6 months. At the top of the page, you'll see technical indicators. There's an indicator called an exponential moving average, or EMA for short, that is key to what I'm about to show you. Now, what's an EMA? Great question. An EMA, or exponential moving average, is a simple moving average that is used to evaluate a stock, index, instrument, financial instrument over a period of time. EMAs differ from simple moving averages in that they place more emphasis on the most recent behavior, recent data, over older data. They're simply classical trend indicators, and they indicate whether a stock, index, fund is moving up, down, or going sideways. The magic of these indicators lies in their simplicity. They give no weight to value, whether the company is making money or its long-term prospects. They simply and clearly indicate if the item in question is trending up, down, or moving sideways. These indicators, and exactly how they relate to the relative position of stock, mutual fund, ETF, or in this case an index, will be described and will be the subject of what we talk about next. So let's continue. Clicking on exponential moving average brings up a 3-box series of lines. We're going to use the 50 and 200 day moving averages for this example. So enter 50 and 200 in the lines 1 and 2 and click draw. What you see on your chart is a line that follows the 50-day moving average and a second line, in this case in green, that follows the 200-day moving average. The 50-day moving average represents a fast moving average, relatively speaking, compared to the slowly more nuanced average that is the 200-day moving average. It is this combination of fast and slow, together with the price chart, that are key to understanding how this portfolio protection method works. We'll dive right into this in the next video, so stay tuned.